Hi everybody, I'm John Young and welcome to another edition of KN Talks. Following the recent CGT changes in the budget, which I think everybody expected, we thought it might be useful to people to be reminded about employee ownership trusts and some of the advantages that they can bring if you're looking to exit your business. So I'm delighted to be joined today by Matt Spencer from our tax team, who's our expert in EOTs. Matt, perhaps you can start by explaining to listeners what an employee ownership trust actually is.
Fantastic. Thank you, John. Yes, it's a very good place to start. An employee ownership trust, or EOT, as people often refer to them, is a trust set up for the benefit of all of the employees of a company. A classic example is John Lewis. If you think about the fact that everyone who works for them, from the most senior to the most junior, is a beneficiary of the trust. So what happens is the company sets up the trust and every employee benefits from it, but you can distinguish in three different ways between employees if you want to. You can distinguish based on years of service, hours worked, and how much they're paid. You don't have to do that. You can treat everyone equally, but if you want to have a bit of variation between people, that's possible. Now, of course, you might be thinking, why are we doing this? Well, we set up an EOT, an employee ownership trust, so it can go on to buy the company from the shareholders. And what this gives is an alternative to the classic ways for shareholders to dispose of their company. The classic routes, which I'm sure everyone is familiar with, is you sell to a trade buyer, you might sell to private equity, you might list a company. What this gives is a fourth alternative, and it's a very well looked upon alternative because you're not selling to somebody who might change the culture of the business. You're not selling to somebody who might strip assets, who might destroy it, hopefully. You are passing it down to the people who work for you, the employees. So it's very, very well looked upon. But how does it work? You create this trust, and the trust has to be governed by somebody. It's governed by a trustee. That is normally a company which is set up to act as a trustee. That's done for liability purposes mainly. Classically, the trust company has 3 or perhaps 5 members. We have an odd number so you don't get a deadlock situation. They are typically made up of 1 or 2 employee representatives, and they sort of look after the interests of the beneficiaries of the trust, the employees. You have the founder or founders typically, and you classically have an independent person who might be a professional such as an accountant, for example. And they make the decisions which governs what the trust as majority shareholder in the company does. I didn't mention it earlier, but the trust has to buy a controlling stake in the company. That could be 51%, but a lot of the time it's 100% of the company. So if you sort of want to know the processes we go through, we set up the trust, we changed the constitutional documents of the company to make it appropriate for one owned by a trust, and then the shareholders sell the trust to, the shareholders sell the company to the trust. And typically that is where a corporate colleague like John might come in for the sale agreement.
That's really interesting, Matt. So from an employee perspective, I think where we can draw a distinction in this structure and a classic MBO would be, in a classic MBO, you'd have a limited number of the management team, perhaps 3 or 4 of the key managers who would take control of the business, run it for the future, and probably look for their own exit in 5-10 years time, whenever they were ready to retire and move on. But here we have all of the owners, all of the employees being owners of the business through the trust, and so presumably it's more of a long-term cultural relationship, much like the John Lewis model, or I guess the to some extent the Guardian model, where it's about a long-term preservation of a culture and an organization, rather than a purely commercial transaction.
Yes, absolutely. Until recently, very few companies had ever left the control of a trust, though it has now happened. These are typically set up with a very long-term plan that it will benefit the employees as they join and leave going forward, a bit like John Lewis for years and years and years. That's the aim of it.
That's interesting. One of the consequences of the structure with the trust and this kind of long-term friendly relationship is that from a corporate law perspective, it's often less complex than a classic trade sale or MBO, something like that, because there is less need for warranties, less need for disclosure exercises, less need for tax covenants. So you actually end up with a much simpler set of documents from the corporate perspective, and therefore both a quicker transaction and one which is cheaper, frankly, because you've got less documentation and less complexity. So that's definitely something which can be a pro for sellers who are looking to move quickly and to allow the employees to have that interest. So Matt, we have obviously got a number of routes for exit. Why would you choose to have an EOT as opposed to, say, a classic MBO or a sale to a private equity buyer?
Thank you, John. Yes. So employee ownership trusts have special status under tax legislation. And as long as you comply with the requirements, there is some very favourable tax treatment to be had if you sell to an employee ownership trust. You pay no capital gains tax on selling your shares to the trust. Now, given the recent changes in the budget to capital gains tax, I anticipate the number of businesses selling to these trusts will continue to accelerate. At present, there is about, I think I'm right in saying, about 1,700 employee ownership trusts in existence, about 30% of which came into existence last year or in the last 12 months. I think that is just going to continue accelerating as people see the many advantages of them. It is not just advantages to the selling shareholders, however. The company that is controlled by an EOT is able to pay income tax-free bonuses to its employees after it becomes controlled by the EOT. Now, this is limited. You can't pay it up to any amount and you still pay national insurance, but it classically gives the company a lot more money it can pay out in bonuses because it doesn't have to pay over through payroll any income tax. So these are two big tax advantages to the EOT structure. Tax should never be the driving force for anything, however, and I've already touched on it earlier. If you are concerned about your company going forward, let's say you founded this company, you've grown it, you have perhaps worked with a number of the employees for many, many years, you might well be nervous about selling it to an unknown third party. You might be worried that you might be cashing out as a seller, but you're leaving your employees in the hands of an unknown person who could damage a business and damage their livelihood, your old colleagues going forward. Selling to an EOT is an effective way of heavily mitigating that risk because those employees become effectively the owners of the company through the trust going forward. So you're looking after their interests in the future. I also think that if you sell to an employee ownership trust, and I think John Lewis is a good example of this, the employees are incentivized to grow the company going forward. And of course, that is a good result for everybody because the company will get more valuable. And as the employees effectively benefit from the growth in value of the company, as they do with John Lewis, the employees will classically end up earning more money than they would otherwise. And why is this? It's because you don't have third-party passive shareholders stripping out income. It's all being fed back to the employees. Now, there are some disadvantages, unfortunately, of course. And the big one that I always get asked about when we set these up is, where does the money come from? If you're selling to a trade buyer, they will hopefully either have the cash reserves or they'll be borrowing the cash reserves to buy your business. When you sell to this trust, that trust has just been set up. It doesn't have any money. Now, companies are classically sold on lots of different valuation metrics, but one of them is a multiple of profit. You might, for example, sell for 8 times your profit, let's say. What will typically happen on an EOT transaction is the company will set up the trust and it will gift however much profit it can afford to immediately to the trust following its setup. Let's say that's 1 year's profit. It will gift it to the trust and the trust will use it to settle the first chunk of the consideration payable to the shareholders. You will then, perhaps annually, perhaps quarterly, whatever's commercially acceptable, continue to see gifts made by the company to the trust which then goes on to pay that money to the selling shareholders. A disadvantage of this is if you've sold on, let's say, an 8x multiple of profit, it could take you, well, 8 years to receive all your consideration. Now, in truth, you'd hope that the company will continue to grow and actually maybe it'll take 5 years, but you're not going to get all your money on day one. You can accelerate it a bit by taking on bank finance, but then the company has to deal with the interest on those bank loans. It used to be more popular than it is now, I think. One, because interest rates have gone up, and two, because sellers are more happy to wait for their money. Now, if you're a seller, there's 2 risks that come with this. One of the risks is, what if the company goes bust 2 years after you sell it? You don't have much recourse there. If there is no money going around, you're not going to get paid the remainder of your consideration. The second risk is, what if the company becomes incredibly valuable 2 years after you sell it? You have to be happy with the fact that that isn't your money. You've already sold. You're still going to get your consideration, but you don't get that uplift after you've sold. Your employees will see the benefits of it, but you won't anymore. You've completed your sale. I would also say it's a little bit more complicated once it's in place to continue to manage the company because you have this trust in existence. So before that, you might have had 1 or 2 shareholders, 1 or 2 directors. Everything's fairly straightforward. You now have a trust in place, which has to be managed according to trust principles. You may be having to pay a salary to a third-party independent trustee. There's a little bit more complexity, but I don't think it's enough to prevent you doing this. It's just something to factor into your decision-making process.
That's a really interesting, Matt. Thanks. So in summary, EOTs are great for 2 things. First of all, for preserving potentially the long-term business of the future and giving the employees a real stake in that. And in return, as a seller, you get a great tax treatment. Real downsides are loss of control, additional bureaucracy through the trust structure, and the biggie, which is the fact this is going to be substantially deferred consideration with no security. So there's a lot more risk in the transaction than you might find with, say, a private equity buyer, which has a substantial fund behind it, or even an MBO in the classic style, where you can take security over the assets, maybe get the company back if they don't pay, or there can be more kind of bank-fueled debt finance to allow you to get more upfront. Of course, most transactions have deferred consideration, and you can never guarantee you'll get deferred consideration even with security, but there's definitely a bit more risk there in an EOT. Still, I think very much worth exploring, given the tax savings and the other advantages that they bring. If you are interested in EOTs or an exit of your business generally, or potentially even other things that can be done to mitigate recent changes to CGT, please do get in touch with Matt or I. We'd be delighted to help you with any transaction that you might be considering. Matt, thanks again. It's been great to speak to you, and I always appreciate you coming on to have a chat.
Thank you, John. Likewise.
Great, thanks. Goodbye, everybody. And before I go, please do remember to subscribe to our YouTube channel if you like this content. We do post regular videos on not just tax issues, but also other issues connected to M&A and issues that might be of interest if you're thinking about expanding your business around the world. We have quite a lot going on at the moment, in particular for businesses thinking about expanding or relocating to the US, as well as some other jurisdictions. Once again, thank you, and see you soon.